Everyone just talks about this stuff as hard tech or deep tech, and there's a lot of granularity. It's like a Waymo is very different from like a TLM that we're both co-invested in versus a Shinkai versus an Anduril. Cool.
I actually did work though. I like a podcast host. I actually did prep work. I'm like more prepared for this one instead of Will just fucking riffing it.
I'm ready. I've done my fair share of prepping for this as well.
Oh shit, this might go for a little while then. All right, let's start with who the hell are you?
Yeah, so I'm Grant. I'm a partner at Cantos. Previously, before joining this firm, I was a founding member of the American Dynamism team at Andreessen. Been a longtime fan and admirer of all things hard tech, and it's been fun to see the rest of the ecosystem slowly come around more and more to it.
So obviously the point, or the catalyst, not the point of this, because I would chat with you anytime. The catalyst for this is you drop more decks than anyone. You drop a deck with more slides than anyone can actually get through. That I want to get to, but I guess backing up, like, why do you think people are getting the plot? What is your take on why broader capital pools are getting the plot? Is it as simple as like Palmer was crazy but right, and now everyone has to chase it, or is there more fundamental analysis to it? Like, why do you?
It's yes and. I think that like the cinematic universe was created, the Big Bang happened, and that's nice and pithy. But I think what you needed in order to have people come in was like there needed to be real companies. There needed to be talent emerging from those companies that were trying to go after other problems in a credible way. And then you needed, I think, in my opinion, like some other big pool of capital to really like be willing to take the leap. And obviously I'm biased because I was involved with this team, but I thought that the launching of the American Dynamism practice was a key inflection point for the ecosystem. And it's not that they were the first to invest in this. In many ways, they were one of the last. But the key insight was that once they established the fact that there was a large pool of capital going after these companies, I think other firms felt comfortable also going after it. And then at that point, Anduril's valuations just continued to skyrocket. And we can definitely talk about that. But I think you needed first the companies, then the talent, and then pools of capital. And it still remains to be seen how many other companies in these categories will support real massive outcomes. But for me, that felt like the right sequencing of events.
So what's the of the 286 slides? I think that's the right number.
Yeah, 286.
What's the single most important slide?
There's two. The first is
I was going to ask you about the next three, but okay, you can have two and then we'll still go from there. Okay. What are the two most important slides?
The two most important slides are one, the deep tech score slide, which is like 51 or 52. And that talks through, I think, something that is missing, which is everyone just talks about this stuff as hard tech or deep tech, and there's a lot of granularity. And it's like a Waymo is very different from like a TLM that we're both co-invested in versus a Shinkai versus an Anduril. And until people have more, I think, precise ways of describing these companies, I think that's going to limit a lot of the category. And so that's one of the important slides as we kind of detail the deep tech score from like what's level 0, which is SaaS. Level 5 would be like OpenAI, shot in the dark. You're raising a bunch of money and the transformer isn't even invented yet. The second slide is the narrative violation slide of how much capital these companies have raised relative to software companies. And you're smiling because we've talked a lot about this. I've heard you talk more about this. But that one was hilarious to put together because someone tweeted, I won't say who, but someone tweeted a photo earlier in February of, it was like their version of a narrative violation of how much capital a lot of software companies had raised versus hardware companies. And I actually went into the data and it turns out that tweet was just completely wrong, like not even close to being accurate. And so we put together the figures. Obviously, there's some selection bias, but the stats were pretty absurd in the fact that software had raised on average $18 billion. And then they had a market cap of around $117 billion. It's like solid outcome, but it was about a 6x in terms of dollars to enterprise value. And then hardware companies, on the other hand, had only raised $6 billion on average. Their EV was lower, it was like in the 80s, but their multiple was double software companies. And so to me, that was like a clear indication of, look, the narrative around this stuff requiring way more dollars is actually not totally correct. And obviously some companies do require a lot of dollars, like a Waymo, but there needs to be, again, more precision about how we are referring to these companies.
Do you think anyone cares about precision?
I don't think most people do, but I do, because
I mean, this is why we get along. Listen, and like, this is why we love Cantos, is because we care about, we think being right matters. Yeah, the way we've been talking about this, I've been talking a lot. I mean, I should say, we've been talking a lot about narrative warfare, and I think, listen, Ian and I know both agree that like ultimately you want to bet on the market being a weighing machine, right? And it's used the Buffett and Munger analogy of like long term, it is a weighing machine that's going to weigh the fundamentals. I think that's led some of us to totally disregard the voting machine component, right? And I think, much to my chagrin, I think I'm like wise enough to come around and understand playing the voting machine game well matters.
Well, and I saw that directly at my old firm, right? I mean, like that they're some of the best at playing that momentum game, and I think like the anointment dynamic really is important, especially in these categories. I think you guys have put out a lot of content about the like old version of venture's dead. And so how do you interpret that today? And so we can keep going down this rabbit hole, but I think I had an interesting seed of, I entered venture with like fully on the fundamental side, the weighing machine is all that matters. And then I saw the other end of the spectrum. And so now I think I like to try and operate in the middle, but easier said than done.
Who do you think controls the voting machine, or is it controllable? I guess, is there?
I don't think it's controllable. I don't think so. I think if
you don't think there's a game plan, is there a game plan to increase the odds that you win the voting machine, or is it fully organic?
I think some firms can do that. I think some
No, you're a founder. Let's say, again, we don't want to talk to other VCs.
Oh, you're a founder. Yeah.
You and I are trying to get in front of more grassos from TLM, right? That's why we're putting this out there.
Yeah, sure.
You're a founder. Is it just full organic? You either understand the voting machine or you don't, or do you think, given you've sat inside of a weighing machine firm now and a voting machine firm in the past, like is it a learned skill or is it just totally organic?
I think it can be learned. I think some of the companies within Cantos, the companies that Cantos and Andreessen shared, that's how I originally got to know Ian and the team. I think some of those founders actually are really good examples of, some of them didn't actually really know the voting machine that well in the beginning. And through a bunch of people's help, hopefully our team's help, they started to navigate that a little bit better. But at the same time, I always think about like the Batesian mimicry effect, where a lot of people, wanted to be Steve Jobs, wore turtlenecks, and we know how that went. And so I think there's an element of like, it always has to be authentic and realistic, and it's easier said than done. I don't think that meant.
Well, and where I'm netting out on it, sorry to cut you off, but without losing that thread, where I'm netting out on it is like, you have to be able to survive the weighing machine eventually. You know what I mean? I think full voting machine games without any odds of winning a weighing contest is like, you're going to get blown up eventually. You know what I mean? So, and I do think there's this thing that founders have to know both games and not get sucked into one or the other. And the reason I bring it up here is I think it's more important for these kinds of companies, right? As much as we all talk about this, these deals are not consensus yet, or it takes a ton of evidence to actually see the broader, right, the consensus capital flow into them. I don't know. So maybe talk about that. Again, everyone likes to talk about this. Everyone has a slide. Like the logos you had in here in terms of mega funds were more than I thought, but like they're still coming in with lots of evidence. Is that fair, or are you watching them?
It depends on the type of investment. It depends on the company. So I think there's some categories like defense and maybe space a little bit, but it's definitely less so now. But defense, certainly, everyone is just piling in, and I don't think people are that sophisticated about how they're underwriting this stuff. And so for me, I'm like, okay, this is great, good to know. In other categories, there's definitely a lot of like, we need to see as much evidence as possible before we wade in. And I've talked about this a lot with Hamad, my co-host at Motion Blur, but like, the IBM-ification of venture is like in full swing. There's a lot of issues with people being very risk off in an asset in an investing seat where you're supposed to be a little bit more like, I think, like leaning into the risk curve. And so for better or for worse, most of these categories still are not anointed or like consensus. They're pre-signal. And that's exciting for us because we can kind of try and ride that curve a little bit earlier. But I mean, that is something that I'm quite aware of, is if some founder's pitching me something and I know that no one's ever going to entertain it, I have to take that into account. It's annoying and frustrating, and hopefully we can be a leading indicator for other firms in the long run. But outside of defense, I think most people in these categories right now are really trepidatious. You could argue like robotics and foundation model stuff, yes, but like that's also a very different game.
Is there one chart from the deck where you're like, this is the chart to pin?
I mean, at this point, I'm gyro dreams of slides.
Yeah, so maybe the answer is you can't even recall which specific charts are in there.
No, I can. I'm just trying to think of the one, like every person I've talked to, different slides and graphs have resonated. I think
give me the top three, or the three that come to mind that people have.
One's on the exit side. This is I deeply believe that every category is always questioned, and then some exit outcomes start happening, and then people are like, oh, this does make sense, and it's much bigger than we expected. And the example I originally gave was Shopify, and then we go into fintech. You're shaking your head. I want to hear what your thoughts are.
I've started to work on a whole deck on the reality of exits within the defense sector.
Yeah. I'm sure it's great.
Yeah. And no, it's just interesting because I actually think the opposites thing is going on, where everyone has kind of like the good and the bad part of these businesses is they have physics, like they have actual physics, and they have business and they have business. I talk a lot about this. Like I talk about the physics of certain businesses and sectors and industries. And I don't think people, right? I think people appreciate that Anduril is like the Anduril of this. The Anduril is the Anduril, right? But then on the other hand, they want to do exits as a derivative of that, and I don't think it exists as a derivative. And so I think when you get into the problem with a lot of physical industries is you have supply chains, you have distribution chains, you have combinatorial systems a lot of time, right? And so like my favorite old guy, it's really funny. I get to be the old guy now. But when I first started paying, when I got my head out of the pool and actually got a job, I had to work with a bunch of optical companies in like 05, 06, who were like literally changing the internet, right? These are like dudes down in South San Jose, South Fremont, who were like figuring out how to make lasers and mirrors work better to dramatically change the bandwidth of the internet. Pretty fucking cool. Like would go in the deep tech category now, and they were calling us because they were $190 million market cap companies that couldn't make any money. And the reality is because like they were the coolest part, right? But they existed in a much broader. They weren't selling the solution, and they didn't have leverage over those selling the solution. It really like broke my brain for the rest of my career on how do you think about innovation that is super cool and has to happen, but tying it to economic outcomes. And so anyway, I don't know the answer in defense, but I think there's like an interesting conversation about the physics there of like, you get long range, you figure out how to do modular long range cruise missiles really well. That's amazing. It'll change the dynamics of war, but like, I don't know what you're worth. Cause like, you know what I mean? Like you're going to get picked up by a prime or a subprime, And so anyway. That's kind of why I'm smiling on the exit side.
Well, that's why I actually think we're saying the same thing in different ways. Like I view this as like the category writ large. I'm not saying just defense. I think the exits across these verticals, and that might be an unfair characterization because this is too wide of a swath, but that's where I was coming from. I fully agree. I think the number of defense exits that are going to be really great venture fund returners is way smaller than most people think. And I actually am hard pressed to, outside of maybe 3 to 5 companies, I don't know how many others will like really drive the needle. And at the same time, the number of dollars going to the defense category continues to go up. And so we at Cantos, I think, are pretty comfortable with our bets here. We have 3. And then obviously like Anduril is another one that people are very familiar with. But outside of that, I'm pretty okay not dabbling more into the space. We'll keep looking at stuff, and there might be someone that comes around with something interesting. But I agree. Like also the power equation. Most people think all you have to do is just build this one product and then you're good. You have to become multi-product at some point in most of these categories in order to actually justify a larger valuation. And that's a very different ball game than just having one SaaS product that does really well and you have a decent enough TAM.
So back to charts. We got away. You like the exit chart? What are the other?
Yeah. I like the exits. I do like the capital intensity. The one thing that you'll definitely appreciate is I have a one table of some of the, top performing early days of venture outcomes. It's like Microsoft, Apple, LSI Logic, all of that. The average capital they raised before they IPO, do you know how much it was? $8 million.
Yeah, there you go.
It's freaking insane. And the average time to IPO for them was 4.6 years.
Well, I know that. So that's why those comparisons aren't fair.
I know they're not fair because it's a very different time scale.
Well, we took the public markets and it happens privately now, and you get 2 and 20 forward and buy convertible stock and not common stock. I think the interesting thing is the more telling stuff. Like, so the problem is every time I bring that up, you get that, hey, that's not how it works anymore. It's like, all right, fine. But how much equity, right? If you go back and look at how much equity Microsoft and Amazon had to sell, even post being public, right? Go in the first 10, it's insanely low.
It's insanely low. I mean, Microsoft only took their venture round because they wanted to have someone on their board before they went and IPO'd. And it was $1 million round.
And Amazon basically got access to really great structured equity and debt along the way. All right. So that's it for charts. What's the 3 or 4, what's the consensus feedback to the deck? Like, what are the obvious, what are the most consistent things people have told you after shipping the deck? And then we'll get into what are the most interesting.
Well, there have been a bunch of people that are investing in these categories nearly as long, and they're like, "Oh, well, we've put together the same slides, so it's nice that you consolidate everything." And it was just kind of funny to hear. It's like, okay, well, I haven't seen any of those slides, so great.
You were going to build Facebook, you would have built Facebook.
Yeah, we did it too. It's like I too am a scientist. Yeah. So that was funny. I think the consensus thing was. A lot of other investors and LPs I'd bucket in one category were like, this is really helpful for me to go to my committee or my peers and have a little bit more ammo and firepower when I advocate for this stuff. I think on the founders side, giving a little bit more language to most of the questions that they get asked are the same ones that we get asked from other people. But the one that they always get asked is this venture scale? And for certain founders we meet with, I think they're really good at bringing that up organically in their pitches. But usually the ones that we're talking to, they always get asked that. And then when they Uno reverse it to the investor they're talking to, the investor really can't articulate what venture scale means to them. And so having a little bit more language there is helpful. I think that section probably still needs a little bit more work, but that was the one that most founders were excited to see. That doesn't surprise me too much. The interesting contrarian stuff was really centered around like, what are the types of criteria that you would use to actually like comprise the deep tech score? And the easy one that everyone always thought about is like CapEx or like time to revenue. But I think the type of risks is also really important. Like, is this something that's going to require a lot of science risk, regulatory risk? Is it just execution? Is it a massive competitive set that's going to be really hard? The other one that we've talked a lot about is like the type of hypothesis. Like, do you actually really know what the hypothesis is going in? And OpenAI, that hypothesis isn't very legible when you get started. And then the other one that I think I have to put a little more thought into is like the market maturity. Because there's some companies that are doing something in commodity space, like a Waymo TLM, like a 2x4 is a 2x4. You're not really reinventing anything there. How you do it, that's interesting. But at the same time, we're seeing some company, like a Shinkai is also a commodity in that they're selling fish, but there's also a story there of how do you like create a new category within that to have like a more premium product, but also like different price structure. So that's something that there has been a lot of literature on category design and market annealing, I think is Martin Casado's version of that. But we need I think a better framing for it.
Who do you think most needs to read the deck?
I think most investors need to read it. If you're investing in this category, it's not, I don't want to like aggrandize this, but I put together the deck with a mindset of these are the questions that I've been basically asked for the past 4 years. Let's put some data. It's not going to be conclusive or comprehensive, fully comprehensive, but here's sufficient data to at least get you a sense of things. And hopefully it gets you to start thinking a little bit more, dare I say, first principled about some of the stuff.
Do you think this is a sector that should have different firms coming in at different stages? This is a thought bubble I've been having.
What do you mean by that? Like multi-stage or?
Yeah, or should there be seed specialists and then Series B specialists in these sectors? I go back and forth on this. I try to figure out how different the underwriting is, right? And like, listen, I think a lot of the great biotech firms, like, it's because they put the first $200 million in. You know what I mean? Like they're like, we're gonna do 10 to get the team together. We know it's 30 to get to a preclinical. We know it's another 50 to get through phase 1. And I've just been trying to think of like, is the core underwriting knowing? You know what I mean? Is it
knowing the full stack or knowing the section? Yeah.
Yeah. Who's better at reading the odds and capitalization patterns? Is it net new investors, or is it? And this is kind of a plug for Cantos to have $1 billion, but no. But I really do wonder if this is like how it. Does it borrow parallels from SaaS, or does it borrow parallels from? And I think this is the interesting part of the deck is like. The answer is like yes. You know what I mean? The spectrum of things in here. I think that's what's really nice about your spectrum slide. Is there's a spectrum of things. Some rhyme more closely with, hey, we can. You know what I mean? Like the novel part only takes a few $1 million, and then it's execution. There's some things where it's like, yeah, commercial traction and value don't go hand in hand. ...
Yeah, I mean, the easy answer is it depends. I think that the challenge right now is that most firms don't have a clear sense of how to underwrite this stuff unless it's just like absolutely in your face working. And, you know, my old firm in their first LP deck ever, when they were fundraising for Fund 1, they had a slide in there that said that they don't invest in rocket ship companies. And obviously things change, and it's not to, chirp them, but at the time it was just very clear, like, let's just focus on software. That's our bread and butter. And at the same time, some firms are going to be willing to take that early bet and others won't be. And so I think there's always going to be some sort of an opportunity. The main challenge is I think the only way to take a full stack approach to these categories is for the time being, I think you need to be pretty concentrated, because if you're not going to be gleaming enough insights from each individual company to know if it's working before the like clear commercial traction is there.
Well, last question, and then we can just riff. But the last thing I was wondering is like, how would you quickly define venture capital? I mean, we all love it, but like, what's your meme on it?
My meme is, what can you do with $5 million? And that's it. And like, if you can't find a path to building something and testing it and get some sort of data back quickly, then you're probably in the other venture capital buckets where there's a lot more dollars willing to throw at you and see where it goes. And maybe you're a Palmer and you're just like ridiculously special and can sprinkle the pixie dust everywhere.
To be upfront about that one, how much of his own money went in before venture capital?
For Anduril?
Yeah.
I don't know off the top of my head. Do you know?
I don't know off the top of my head, because that's always the funny thing about SpaceX.
Yeah.
Right, where everyone's like, Founders Fund was the first venture dollars, and it's like they were, and they fucking got it. But like, also,
they got it.
Elon was 100 in.
I know, he was 100 in. That's the thing. Like that's the hard thing about this category, is that if you look at this stuff, a lot of them aren't pure venture bets. Like the first dollars in were post real, like, I mean, $100 million. Like that is not an OG venture bet. Tesla is another good example. Like, what the heck was that? And so you could make a very clear argument that Anduril was the first like proper venture bet, and that still had like a pretty monstrous seed round. But I think I mean, Palmer's talked about this, like you need to be a billionaire to start one of these companies, and hopefully that changes. I think the type of company that they're building is more deeper than some of the other stuff that we get more excited about investing in.
I do. When I look at the really interesting moonshotty for better or worse. Not straight in your definition, but like stuff that's like big structural changes to how the world works and how a particular problem is solved. My ongoing issue is there's been a really good role of irrational capital, right? Like non-return seeking capital that's been involved, whether that's government right back in the day, whether that's Elon and his capital being a bit religious about going to Mars. You know what I mean? That's one thing I meditate on a lot is like, where do you find the source of slightly irrational or non-return seeking cash? The other one that's right that you want Will's really far out take.
Yeah, I want the real.
All right, here's my far out take. I think the established. How am I going to say this succinctly? Maybe Gigi can figure out how to cut down, or you can give me the meme back to me. The reality of biotech is like there is no value, right? There's like 10 years until there's any classically trained commercial value in these assets if they just had to run themselves. And so I think actually one of the biggest things to happen to humanity, which is a bold claim, but I think it's true, was the establishment of a capital market for non-commercial value in biotech, right? Like the fact that eventually phase 1 data had X value and phase 2 data got Y value and phase 3 got Z, I actually think has had like a wildly huge impact on humanity, right? Because now that you have that structure, you could 1000x the amount of capital that flows into the ecosystem because you didn't need people waiting for 10, the DCF wasn't off all the odds it goes right for 10 years. Does that make sense?
Right. Yeah.
And I've been trying to, it's like whoever like first was like, hey.
But what's that version for this stuff?
I've been trying to think about it forever. For like 5 years, I've been trying to figure out who the first person was to say there's value in phase 1 data. Right. And I've asked some OGs in the biotech sector and haven't gotten a great answer. And 2, I've been trying to figure out like, is there an opportunity, right? Is there a play where the actual other Neo Prime doesn't do any of its own innovation, but starts with a bunch, you know what I mean? Has like, you buy a shell with a bunch of relationships and you're like, oh, like you failed to fully get off the ground, but you do have novel tech in this sector. Like we know what, you know what I mean? That's worth, and it's kind of why I think Anduril is the compounder, right? Is as much off their own innovation is they can start putting, right? If it's $100 million to get through a program for a directed energy system, right? And you get 30 in and you get it, like they can understand the value of the science, I guess. Does that make sense?
It kind of well, there's that's also the frame of thought of like all the roll up ideas in Dynamism and now AI land, where it's like, oh, we can buy this stuff and then just like slap our distribution on it or whatever. And I think where rubber meets the road for a lot of the roll up stuff starts to fall apart. We've talked a little bit about that offline. But I mean, like that's the thesis Anduril is trying to do is like, can we arb some of the other companies that are they're not necessarily venture backed? We acquire them, and then we get to integrate that into our fleet. Now, I think the integration, like, we'll see how that goes. It's
right, and I just outside of defense, like, well, again, if there's like a liquid commercial market or a liquid market before commercial viability, that like changes the game dramatically. So anyway, that's like actually my big take on climate change or energy innovation is it's kind of all or nothing, which is really hard, and it restricts the amount of capital that'll chase it. And that's like a self-fulfilling prophecy of you get less big outcomes.
What are some of your other thoughts from the deck?
What are my other thoughts from the deck? I'm trying to figure out what I actually want.
What's your most contrarian take from the deck?
That even the really good thinkers about venture capital are missing some of the nuances of business physics, right? I think that like they're still dreamers, you know what I mean? And I think that's necessary but insufficient. Right? Who like don't quite appreciate. Listen, like I get a lot of pushback on my thesis from there, which I think is like the counter of it is like, yeah, I obviously think that's right. And so for everyone, mine is like investing in automation is like a wildly terrible idea. And it's just like if you do the math of how much it costs, how quickly it gets commodified, and how much margin you collect, it's like versus building services, net new services businesses off the top of it. And like I think there's a bunch of other theses that came out from in there that suffer a little bit from that of like, oh, this is rad. Like in general, I'm not sure.
But where does rubber meet the road? Yeah, I know.
Where's the returns?
There was a slide that I wanted to include that was like, how do you spell EBITDA? Which we'll probably add to the next volume.
And then like divide that by the capital needed to get to something that is EBITDA. I think watching it go viral and everyone love it. The interesting thing for me is like so much of it is just rooted in old school venture principles, which I know Ian and I have done at length, both having some history around it. It's like I think it was like, oh, this is just good venture capital, and that's like a controversial takeaway.
I know, but it's people think it's brand new. Yeah,
I'm like, oh, this is just how you do proper.
Well, we had that like section for like what we think like, constitutes a venture scale opportunity. And it's basically like high growth, high margins, low dilution or capital efficiency. And, it's pretty easy to find 3 quotes from Sequoia very quickly that all just focus on those 3 things. And like, everyone's like, wow, this is like so profound.
But even those firms treated as profound of like, hey, we're getting into American dynamism. Like the answer is like, oh, you're doing good venture capital.
Yeah, exactly.
You know what I mean? I think that's the ironic thing. You want to grill me at all? I feel like we got a bunch of good stuff here.
Yeah, this was good. What do you think? If you could educate founders on one thing right now, what would you drill on them?
2 things. Since you picked 2 things when I asked you to do one, I think the first is this idea of narrative warfare. Right? I do think, and that's just me projecting my own thinking of like, I do think we're at an era where voting machines can change the outcomes for weighing machines, or like winning the voting game can change the weighing game for you. And just being aware of that, I think I've probably been too much in that just put your head down and grind. And so I think that especially in this sector that matters, right? If you can declare yourself a victor and explain why it's important, I think that matters. And I think the second is kind of why I do the work around what I'm now calling slow conviction is like so much is knowable on day 0, like, and so much can be forecasted around and so much can be, right? If you just step back and go like, what's it actually going to take us to run this experiment? You know what I mean? And like, what are the milestones? I like to say like, make sure you're climbing the right mountain, but also make sure you've designed a route that like doesn't take you to a cliff or a canyon. And I think especially in adventure capital, that's important to like step back and go like, here, if we're maximally correct, you know what I mean? Like here are going to be the air pockets, or here's going to, it's going to take, sure, on 5 million, we can flip a really good card, but the next card's 30 million bucks. I'm like, am I signed up for either raising that money irrationally or like making the 5 last long enough to put up the evidence? And I think that's one thing I just really implore founders before they even incorporate, right, and put their own opportunity costs on the line.
Yeah, they just need more intentionality. Yeah, I mean, that was another thing that we probably didn't hammer enough on this, but most of the conversations with our founders in our portfolio is just like, you can't do the, YC, lean startup, spray and pray, pivot yourself to greatness. Like there is one of the challenges of having something that is more capital intensive than just pure software is that you only have so many bullets in the chamber. And so you got to figure out how you're going to use them. That doesn't mean though that you're like screwed from the start, and there's a way to be a lot more thoughtful. Like you're saying, like that kind of ties to the idea of like the maze historian. It's like, it's not good enough to just navigate the idea maze. Like you need to know everything about the category before you get started. And sometimes the way to uncover information is to start doing stuff, but that's, this is where you can just talk yourself in circles.
Yeah. So those would be my 2 things that I think these days.
Tell me more about the slow conviction thing, because that's new for you guys, right?
I mean, I've been talking about it forever, and I'm just bad at. I've decided I'm like a really good technical engineer and a terrible product person. I mean, we called it slow PhD for a long time. I've kind of rebranded it because that caused a lot of questions. And I still need the meme. I don't have my own narrative on this, right? I don't have the meme on this, but the idea is twofold, really. Like the biggest asset going into a company is a founder's opportunity cost. And if you actually quantify the opportunity cost for founders, you really are excited to back, it's millions of dollars. And I don't think they get the level of support they deserve or need to make that investment as wisely as possible. I think historically, the cost of venture capital was so high that it was that if I could raise, it was a proxy for the, like someone had thought through a bunch of stuff that a founder wouldn't on their own, right? A VC had thought through a bunch of stuff. Didn't mean it would work, but I was like, it's probably worth the shot, right? Because I could do one deal every 3 years. You can do one company or I do one deal a year. You do one company every 3 years. Like, it's kind of close opportunity cost wise. And so I understand how it used to work to be efficient for founders. I think we've obviously lost that now that opportunity cost for capital is zero. If you shoot a bullet, you get another one. And so, so that's kind of the guiding light of it is like, is there a set of questions and framework you can do to help founders improve their odds, be aware of their payouts? And underpinning a lot of that is like a shit ton is knowable from history on day one, day zero, day -1. And so marry those two things for a couple months as opposed to call a customer, find a problem, start building and iterate, which like I get good business come from that. I think that's a really good idea for low opportunity cost. You know what I mean? If you're like really smart and in a dead end job and not connected, but I think there's a lot of great people that don't need to take that level of risk when they start something. So I'm trying to put myself out there as the resource or a resource to go do this.
Well, we'll endorse that. Maybe as we get to the finale here, what is your definition of venture capital?
That's a great. I like your definition, which is like you got to do enough on 5 because the next 20 is not coming without some evidence.
Yeah.
Right. I mean, I like that idea. I mean, I would call that venture, but we have to call it something else.
Yeah. Yeah.
I mean, that's kind of my line is like, I want to bet my job is to find novel hypotheses, right? That you can get true or false answers to on very little money. And a true answer is like objectively wildly valuable. And then there's more experiments to run. Right. And so I think that nests very neatly into it. Yeah, and I think a part of it is like being 1% rationally irrational. I think there is do things that I always say like the best things to go do. People from that world will laugh at you at first, and then after 5 minutes, hear your explanation, be like, I don't necessarily agree, but I get it. And those are like, yeah, like I don't agree, but I get it is like what you're looking for. If you put those two things together, cool shit happens.
I love it. Yeah, we're working on the narrative warfare, but we'll get there.
All right, I'm gonna clip us. This was good, dude. Thanks for doing it. Hopefully we get some traction out of here.
Always a pleasure.
All right, yeah. GG. Check you later. Thanks, Grant.
See ya. Bye. Thanks.